Hi, in this video, I'm going to talk about some changing definitions, and I'm not going to talk about birthing people or undocumented workers. I'm going to talk about some definitions that relate to us DIY retirees. So stay tuned for some changing definitions. So how do you define a recession? Once upon a time, 2 quarters of declining economic performance, a negative gross domestic product number, would equal a recession. And since we've already had one first quarter number of minus 1.6 GDP, and we're expecting at the end of this month another reading for the second quarter, the initial reading for the second quarter. And according to the Atlanta Fed and their GDPNow tool that uses various readings to come up with an estimate, they're now currently reading a minus 1.2% GDP for the second quarter. That would be 2 quarters in a row of declining economic performance. Well, I'm expecting a lot of people to be changing definitions of what a recession is, and they'll point out, how can you possibly have a recession with such strong jobs numbers? Did you see the jobs numbers this morning? Yes, we did add strong job numbers this morning for June, but I'll get back to that in a minute. During the 1980 presidential campaign, Ronald Reagan accidentally said the word depression to describe the terrible economic conditions that they currently had during the campaign. And President Carter reminded him that's not the right term. Well, Reagan responded by saying, "Let the record show that when the American people cried out for economic help, Jimmy Carter took refuge behind a dictionary." Well, if it's a definition he wants, I'll give him one. A recession is when your neighbor loses his job. A depression is when you lose yours. And a recovery is when Jimmy Carter loses his. In fact, presidential administrations don't get to declare what is a recession. As I've covered in previous videos, that's actually not issued by the Bureau of Economic Analysis or the Bureau of Labor Statistics. It's the Business Cycle Dating Committee of the National Bureau of Economic Research, a nonprofit independent research organization. And as one CNN reporter recently put it, it's 8 white economists you've never heard of, injecting a little bit of critical race theory into macroeconomics. Well, the fact is that these economists date recessions to be used in economic analysis. And sometimes it takes them a while to decide what's a recession and what's not. This is the strangest economic condition I've ever seen. And if it takes a while for some economists to decide whether it's a recession or not, more power to them. This morning we received the latest job numbers, and June added about 372,000 jobs, which was a strong number. It was a little bit better than expected. It's still not the robust 500,000 a month that you had earlier in the recovery, but it's not the traditional standard average 150,000 jobs that you might expect when things cool down. The unemployment rate stayed flat for another month. That's 4 months in a row of 3.6%. But the labor force participation rate stayed pretty level at 62.2%, and the employment to a population ratio was about 59%. And both of those readings are below when the pandemic started. So while it looks like a strong labor marketplace, it still hasn't recovered from the pandemic yet. So are we in a recession? As a DIY retiree, I'm less concerned about the definition of a recession than I am about the definition of inflation. And right now, inflation hurts a lot. Next week, we're going to see the latest reading for the consumer price index. And as you recall, that may have an 8 or a 9 handle on it, which doesn't look like inflation is coming down by CPI readings. But as we've covered before, the Fed follows the personal consumption expenditures ratio, that index, and that was last reading was 6.3. And so we're going to see if when that comes out in a few more weeks, we'll see what that reading is. I think unless we see something surprising with the CPI number and it starts to come down like a 6 or a 7, I think we're on track for the Fed to raise rates again in July, maybe by 75 basis points. Well, I think you have to get above where their PCE inflation reading is before they're going to tame inflation. I've shared this slide chart on my Twitter feed, and if you haven't followed me there, please do so. But if you can see, the last time they tightened monetary policy to bring down the inflation rate, once they raised the rates above PCE, PCE started to head down. Unless we see something very surprising with the CPI reading next week, I think we're on track to see a rate increase from the Fed at the end of this month. The Federal Open Market Committee will meet in the final week, and then they will likely raise rates by 75 basis points. And then a few days later, on that Friday, the 29th, we're going to see the first initial reading of the GDP for the second quarter. And if that truly is a negative number, you are going to hear a whole bunch of people howling that they're raising rates in the face of a recession. Now, keep in mind, Paul Volcker, when he was crushing inflation, had to produce a double dip recession. And that was finally enough to bring inflation under control. I hope we don't have to go through a double dip recession this time. I hope that we can get above PCE and bring inflation down and get it under control. Maybe we'll see a softish recession. What do you think? As I've pointed out before, the real problem is the balance sheet and the M2 money supply. Both are really high after dumping all of that quantitative easing into the economy. And I think as long as that's there, we're going to see inflation. So the faster we can drain that, the better. Now, the Fed started that in June, and they're on track to reduce the balance sheet by $400 billion, which sounds like a lot. Not when it started with $9 trillion. I also on Twitter shared this article, which I recommend. It's a op-ed in the Wall Street Journal that points out the M2 numbers. The writers note that in the quantitative easing, and again, that's dumping money in the economy by buying things, in the first round of QE, quantitative easing after the financial crisis, the Fed increased the money supply, M2 money supply, an average annual growth rate of 6.6% from 2009 to 2014. But again, inflation didn't go crazy. So this time around, after the pandemic, the Fed decided to go even bigger and bolder to respond to a worldwide pandemic. This time they amped up the M2, an average annual growth rate since 2020 of 16.3%. That's a lot. That high M2 and the numbers on the balance sheet are really what I think is driving inflation. I'll conclude with my standard warning. I am not an economist. I am not a financial planner. I have no initials after my name. So take this as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. See you next time.